Hello, this is Josh Belk with the Belk on Business podcast. On today's podcast, we're going to pick up talking about this series or work our way through this series on our mindset toward money, And today we're going to talk a little bit about cash flow. I started this series, and it's been the point of reference that we've talked about here over the last few weeks as we've recorded these. And it has to do with a story from when I was probably about 8 or 9 years old. My dad coming to me one Saturday morning and saying, "Son, we need to take a road trip. I have someone that needs a little bit of help. And would you want to come along with me?" And as a 8, 9-year-old boy, I'm evaluating whether or not I want to spend the day with my dad, riding in a car, kind of get to do cool things with my dad, or do I stay home with mom and then probably get stuck doing chores around the house, which is usually the case on Saturdays. Well, of course, being a very selfish young person, I decided to go on this road trip with my dad. And so one thing I really enjoyed doing when I went with my dad is he always let me be the navigator. And what that meant was I would get in the passenger seat of the car, and if you remember in the days when I was younger, before there was GPS or these apps on our phone that can help us get to our destination, it required a map. And so I would go into the glove compartment, I'd pull out the big map, and I would look at my dad, and he had already told me why we were going where we were going, and it was to go and to be a help. And so I understood that, okay, my dad, it was his heart, it was his passion, it's what he loved doing, it was his purpose really, and he did a lot of this, was helping other people. So I kind of got that. And so the next thing I needed to know is, well, Dad, where are we going? So he would tell me, and I'd flip the map over, and I would go and find on the map where that destination was, and I'd find a little quadrant where it was, and I'd locate it and put my finger on it. And I realized at this point I had a problem. And I understood why we were going where we were going. Now I knew where we were going, but I was missing a third piece of the puzzle, and that was, where am I at currently? And as business owners, we need to understand these things as well. We need to understand where we are going. We need to understand why we are going there, the purpose. And we've talked a lot about that extensively over the last couple of weeks on this podcast, really kind of digging into purpose. And then, so I know the purpose. I know why we're going there. I know the why. I know the where. Now I just didn't know where I was at currently. I didn't know that other where piece, okay? So I knew the destination, but I didn't know where I was at currently. And cash flow is that way. Cash flow is a picture of kind of what have we done in recent days and where do we sit currently. Now, we're going to talk a little bit about cash flow today. We're going to mention a couple metrics, and then as we move into next week, which I think will be the final week in this series, we'll get into a little bit more on practical areas that we can look at, especially on the balance sheet as it relates to making a determination on whether or not our business is truly healthy where it is at currently. And so as we talk a little bit about our mindset toward money as it relates to cash flow, it really is going to lean into the health of our business. And cash flow, looking at the right metrics as it relates to cash flow, will truly tell the story on the health of our business. Now, when it comes to cash flow, it's rarely defined. You guys have probably seen it, these T-shirts and, this type of thing, and, where it says cash flow on it, or hashtag cash flow, or you see these influencers or these business people just touting this word cash flow. However, it is rarely, if ever, defined, which is normally what we see with cash flow. Cash flow is kind of really can be positive, it can be negative, it can be neutral. Okay, we can have all kinds of cash flow, and cash flow really is kind of an emotional type of a thing, and it's the way it's really being presented is in an emotional kind of way, but it's not. Okay, the reason why kind of the cash flow and it feels good, that type of thing, is because that movement of money around kind of really helps feel like we are doing something, like we're functioning well in business, that type of thing. Something is happening. We're moving. And but the same thing could be true of a basketball player. A basketball player can just be running around the court. They're moving and they feel like they're part of the game, but they really aren't contributing. Okay, so if cash flow is something that can really provide emotion, but it can be really kind of deceiving if it's not the right types of cash flow. And I'll talk about that a little bit. So, the cash flow, that whole thing, it sounds bravado, it sounds, kind of cool and this type of thing. But you know what, if it isn't the right type of cash flow, if the cash flow isn't being managed well, our business is going to suffer and probably die, okay, if we don't handle that cash flow correctly. So our cash flow, think about how it comes from. So our cash flow can come from sales. Okay, our cash flow can come from an increase in debt. Guess what? I go and get a loan for $100,000. I put it in my bank account. Guess what? I've created cash flow. All right. However, it came in the form of debt. So our cash flow can come in the way of revenue through sales. Somebody buys something from us, product, service, whatever the case may be. They pay me. That's cash flow. Okay, I go through and I take a loan. That's cash flow. But there's also other ways that we can see a change in our cash flow. It can come almost in a way we don't directly see. That can maybe comes from from tax reduction, okay, or through a reduction in expenses. That will increase our cash flow. So either increasing our top line increases cash flow, decreasing our kind of those below the line expenses, that can increase my cash flow, or I can bring on debt. That can bring in additional cash flow, or I can bring in equity participants. Okay, so that comes through capital infusion into the business, and that can also be cash flow. So understanding ultimately where is that cash flow coming from, and why do I have that cash flow? So that's kind of one thing we need to understand. What is cash flow, and then how does that impact my business? So your income statement, one question we get asked quite frequently is, Josh, you prepared our tax returns and we look at our financial statements, whatever the case may be, and it shows that, we made an awful lot of money. Okay, it shows my net income is, this large number. I have no idea where my money went. I have no idea where it's at. If your financial statements show that we made $200,000 this last year, why don't I have $200,000 in the bank account? Okay, and so that's kind of a familiar type of a question that we hear quite frequently. And a statement of cash flows will help us understand where the cash flow came in and came out. And I'll talk about that a little bit here more in a moment. So so just kind of realize that your income statement can show a large amount of profit and you have no cash in the bank, or in the alternative. You can have a business that's showing a $100,000 loss in the last quarter, but have $500,000 in the bank because you either brought in equity money or you brought in debt. Okay, something that essentially either has to be at some point repaid. So unfortunately, many business owners operate their businesses in the way that they operate their personal finances. They take out their phone or they look on their laptop and they pull up, how much money do I have in the bank account? And we hear this in personal finance as well. They just pull up, oh, okay, I have money in the bank. I can spend it. Okay, and sometimes business owners have a way of just kind of operating their business that way as well. Oh, I have this money in the bank. How can I go about spending it? Not the best way of going about running our businesses. And but unfortunately, I've seen, and I think there are probably too many businesses, especially those that are kind of in those early phases of business, kind of operate this way. Just simply how much cash is coming in, and I'm just going to go through and spend it without a whole lot of planning or thought to the process on how they're going about the money coming in and how is the money, or how should the money going out. So a little planning is done to make sure that there's cash beyond the next week or two. So many times in our personal finances, we get paid every week or every other week. Do I have enough cash to get me to the next paycheck? Business owners many times do the same thing. We did our monthly billing. Do I have enough cash to get me to the next month? Okay, so not enough adequate planning done as it relates to that cash flow. So as a business owner, we really should have a purpose, a reason why we took this product or service to market. So a problem we are solving and think we are uniquely qualified to solve, and something that differentiates our business from our competitors. So as we kind of go through and we identify this is what our differentiator is, get that thing to market, then we begin to see cash flow coming in. And so once we've gone through, we've identified our purpose, we've talked about the last few weeks, our purpose, and then we've identified what is that unique area, what is our differentiator, and then what is that vacuum in the industry that we think we can uniquely fill, and then we go and we fill it, and we take that product, we take that service to market, and we begin generating cash flow. So starting off talking about cash flow, how is it improperly defined? Okay, how should be properly defined? And now moving into an understanding of a little bit of cash flow statement. So there are three financial statements. You have an income statement. It's the one that most people like looking at frequently. So they go up and they pull up their income statement, or sometimes what's called a P&L, profit and loss statement. And so they pull this up and they say, okay, well, my bookkeeper or my accountant said that we made X amount of dollars this last month. Great. They feel like their business is doing well. So that's kind of the statement that a lot of people, they kind of measure the health of their business on whether or not that bottom line is black or whether that bottom line is red. Okay. Then the second financial statement is that of a balance sheet. So a balance sheet, how much cash do I have in the bank? Who owes me? Who do I owe? And then equity in the business. Kind of oversimplified, but those are kind of the areas that you see your assets, your liabilities, and your equity accounts, your equity section of your balance sheet. So that's kind of a statement, and that doesn't get looked at quite as often. And then you have the statement of cash flows, which is generally, when I go through analyzing a business and the health of the business, that is usually the first financial statement I go to, which is the one that is less likely to be looked at. And that statement of cash flows, and I'll talk a little bit about this, is kind of broken into different sections. But we need to understand that that statement of cash flow is one that really helps provide coordination and control inside of our business. So cash flow statements, cash flow planning, it is paramount for business success. So cash flow planning, understanding how my cash is coming in, how my cash is going out, is part of the overall strategic plan of the business as it moves to achieve coordination and operating control within the organization that we operate. Okay, so understanding that cash flow is essentially what we are going to utilize for coordination and control inside of our business. So what is the cash flow? What are those areas that you'll be looking at inside of a cash flow statement? I'll talk about that a little bit as we work through this. So we see when we start with the cash flow statement, it starts with our net income. Okay, so it starts with the bottom line of that P&L. We go through and we add in cash flow from operations. So any sort of cash flow, positive, negative from the operations side. I'll talk about this a little bit more here in just a couple minutes. So we're adding and taking away such things as depreciation, changes in inventory, changes in AP, AR, etc. Then cash flow from investing. So that would be through some sort of investment gains or losses. Could be most of the case time there unrealized gains or losses. And then cash flow from financing, which is essentially cash used, either brought on from debt, reduction in debt, or also the equity account. So either we returned equity or we had more equity come into the business. So those are the areas. Starts with our net income. We have our cash flow from operating activities, cash flow from investing activities, and then our cash flow from financing activities. So when we look at that financial statement, it's going to start with our net income. We know the cash flow that came in from sales. We know the cash flow we deployed as far as expenses. Now I need to know those other areas that are impacting my cash flow. Okay, so did I pay down debt? Did I bring on debt? Did I have a decrease in inventory, an increase in inventory? And once again, those are balance sheet items. And I'm not going to see my cash going out the door to reduce debt or my cash going out the door to increase inventory on my income statement. Nor am I really going to understand it from my balance sheet unless I'm looking at a comparative balance sheet. So a statement of cash flows is going to tell me right away from my net income or my net loss where was the other cash movement inside of my business. And so we can take a look at that statement. Of course, this is over an identified period of time. So as I sit here, we're into the beginning of July, mid-July as I record this. And so I go back and I'm looking at the first half of the year as I'm having my quarterly calls with my clients. And we go through and I look at the cash flow. I will know right off the bat whether or not this business is functioning from bringing on a bunch of debt or bringing on a bunch of additional money from equity. I can tell right away whether cash was deployed into increasing inventory or into doing something else inside the business to try to help it grow. I can see whether or not the business was really aggressive in paying down debt. The statement of cash flows is going to tell me all of that. Okay, so really having a good understanding of the statement of cash flows, I can look at it right away and understand whether or not my business is getting healthier or my business is getting sicker. I don't know if that's a word or not, more sickly, whatever the correct word is there. If my business is not as healthy as it was. So is my business getting better or is it getting worse? Okay, so really kind of having a handle of the statement of cash flows and being able to take a look at it within a defined period of time, and it's really going to tell me the direction of my business as it relates to its health. Cash inflow. Okay, so cash inflow. Cash inflow can either be good or bad. It's like air. Okay, I can breathe in good air, or I can breathe in bad air. Okay, so good air, good type of cash flow is that good clean air. It comes from sales. It comes from a positive cash flow type of an end. Okay, from the reason why we're into business is to make money. Okay, am I truly making money? That's positive cash flow that's coming in from sales. Okay, or it can be bad air. It can be bad cash flow. Now, debt isn't always bad. I don't want to establish this as like, debt is awful. I think on the personal end, when we're talking about personal finances, avoid debt at all possible. Pay cash for whatever you can pay cash for, vehicles, whatever the case may be. Don't use financing as much, if at all, in your personal. Maybe you have a mortgage, whatever the case may be. Avoid consumer debt at all cost. Okay, that stuff will kill you. It'll kill a business too. Microloans will kill a business. Interest-only loans will kill a business. It can have the wrong type of debt as well. Okay, so if you're paying these types of, if you're having an interest-only debt on a depreciable asset, guess what? Your balance sheet's going to end up in a really bad place. That's bad cash flow. Okay, because eventually I'm going to run into a situation to where my asset value is going to be a lot less than my loan balance. I'll talk about a little bit more about this next week, and really one of those indicators of whether or not my business is healthy or not. Okay, and we'll talk a little bit more about that in next week's podcast. But that's the wrong type of debt. Okay, the right type of debt is one that's leveraged properly. Okay, and so I need to understand this from a cash flow perspective. I can either have good air coming into the business, good cash flow, or I can have bad air coming into the business. We know if it's the bad air, if I'm breathing in bad air, eventually I'm going to get sick. If I'm bringing in the wrong types of cash flow, guess what? My business is going to get sick. Okay, and it's going to take a very long process to get that business healthy if I ignore it and I simply just continue to add on to to those things that cause my business to get more and more worse as it relates to its overall business health or lack thereof. Okay, next, free cash flow, understanding what free cash flow is. What is free cash flow? You may have heard this term before. Free cash flow is essentially a short-term measurement of our business health. So it's sales revenue less operating cost, less taxes. And so you kind of go through and so your sales revenue less your operating cost and taxes. You have your investment in operating capital, or simply how much money or how much cash does the business have left over after it pays all of its expenses. Okay, so you go through and you're essentially, what are your sales? What was your sales revenue? What were your operating expenses? Your tax exposure, and then also understanding what is the cash that was deployed on the balance sheet side. So reduction of principal, things of that nature that I may have, credit card payment, things of that nature that are reductions on the balance sheet. So all of that is part of my cash flow as well. So at the end of a certain period of time, how much cash flow do I have left? This is really something you should be looking at into your business weekly, at most, at least monthly at minimum. Okay, so you're going through and you're going through a situation where you're looking at your free cash flow. Do I have enough cash after I pay my bills to continue rolling this thing, or am I living paycheck to paycheck? My free cash flow is going to tell me that. Okay, so I'm going through, and if I'm not able to pay my bills, if I don't have any cash left over, okay, eventually I'm either going to have to take on debt. I'm going to have to increase my sales and try to keep my other operating expenses down. I'm going to have to do something inside of my business to get that number in the black. So as a business, we want that free cash flow to always be positive. Now, different types of businesses are going to have different levels of free cash flow. Okay, so if you're going through and you're spending a lot more on inventory, for example, you're in a business that is inventory and you have to pre-purchase that inventory, that free cash flow may be a lot less than a business that may just be a service business. So when it comes to the free cash flow, kind of understanding a little bit of the nature of the business, the cycles of the business, things of that nature when it comes to analyzing that free cash flow. So a free cash flow may not be as great in a business that's really investing in a lot of areas to try to help its business grow, or it's getting to the point of simply trying to stabilize the business. Those are areas where free cash flow may not be as high as a business that's kind of just running along smoothly. But it is a metric that should be looked at and seeing whether or not my free cash flow is improving, or if my free cash flow is in the negative, it means I'm going to have to bring on debt, and that means my business is in trouble, and I need to do something. I need to change something. I need to tweak something. I need to work on something in order to get that free cash flow into the black. So free cash flow, understanding what it is, taking a look at it weekly, at minimum monthly, at most weekly, looking at it week by week, making sure that you have enough cash to pay your bills and that you're continuing to trend in that way. Next here is operating cash flow. Operating cash flow is essentially it's a ratio. Operating cash flow ratio is your cash flow from operation divided by your current liabilities. This particular ratio is one that a lot of bankers look at, a lot of financial analysts look at, and essentially what that is it's a ratio that's analyzed at if that particular ratio is neutral. Okay, meaning that my cash flow from operations essentially is equal to my liabilities. Okay, and so that number is 1. That's neutral. A ratio below 1 means that the company would need more capital to pay a short-term liability. So I'm dividing cash flow from operations, which is on my cash flow statement. So you're going to take that number, you're going to divide it by your current liabilities, which you'll find on your balance sheet. Okay, so you take those numbers and you divide it. If that number is below 1, okay, if that number is below 1, if that ratio is below 1, it means that I don't have enough cash flow coming in to pay for my current liabilities. Forget long-term debt. Okay, I don't have enough cash flow to keep that business operational. So if that ratio is below 1, your business is in trouble, and you definitely need some help. A ratio above 1 means the company has cash flow above its current liabilities, which every business really should be. And if you end up in a ratio below 1, it's something you definitely want to get onto right away. Identify the problem areas, get those resolved, get that ratio above 1 where it should be. Operating cash flow or cash flow from operations can be found on your statement of cash flows. Essentially, it's equal to your net income plus your non-cash expenses plus changes in working capital. I talked about that a little bit ago. So other items that will change your operating cash flow is going to be depreciation, understanding that. When you look at your P&L, a lot of businesses don't capture that depreciation month over month, but that will appear on the statement of cash flows if you're running it on an accrual basis. So your depreciation, changes in accounts receivable, changes in accounts payable, your inventory decreases, increases, etc. Those things are going to affect your statement of cash flows. Okay, but these are things you need to be looking at regularly, understanding how that money is coming in, how that money is going out. And then lastly, my last point here, what should you be looking at weekly? I've talked about this. Three metrics you should be looking at weekly as the business owner. Number 1, sales. How are your sales trending? Now, if you're in a seasonal type of business, I have an accounting firm. We lead with tax. It's the area that we work in the most. And so I'm going to have seasons where my sales are going to be greater than others. Okay, it's going to be higher than others. However, there are certain types of sales or subscription sales that I am looking at month over month. So is that subscription model that we have at the firm level, is it going up? Is it going down? And I'm looking at that on a month over month basis. And I have certain metrics I look at inside the firm, and I want that recurring number to be over my overall payroll and benefits number. And so that is the one metric I look at inside the firm. So if you're a client listening to this, you kind of get a little bit as far as on the what I do from an analysis end. And I ask my right-hand person on my team every month, where are we at? Where's this number at? Is it above or below? It's kind of one of those things where we're able to bring on more team members. That's the metric I'm going to look at. So sales, looking at the sales number, that's going to be one area you're going to want to look at. Next, your free cash flow. We talked about that. Okay, that free cash flow. Looking at it at least month over month. You get those monthly financial statements. What's my free cash flow? And taking a look at that. And then I think really probably doing it weekly is not a bad idea. And then your operating cash flow ratio, which we talked about here just a moment ago. Where if that ratio falls, is it above 1? Is it below 1? Is it if I'm below 1? Am I getting closer to that 1? If I'm above 1, is that number improving? If not, why? Understanding why is it that that number is not improving. And it may be for various reasons. Okay, so it may be some sort of, we talked about earlier, some stabilizing activities being done in the business. It may be one of those situations to where you're in a process of growth, so you're investing more. A little bit later on today, for example, I'm going to have a call with a software vendor, possibly changing the tax software that we use, and it's going to be a many multiple of what we spend now. Okay, so that's going to affect my cash flow. I know I'm going to deploy a lot more cash this month than I would historically on tax software. So when I go through and look at my numbers, my cash flow numbers aren't going to be as good. However, I have an understanding of knowing that, why? Is because I deployed capital that I earned in the business into a software that I believe is going to help us as a team provide a better experience for our clients, and also to help us internally be able to do some things that we would like to do. So looking at your sales weekly, your free cash flow, and then also your operating cash flow ratio, understanding the impact that it's having inside of your business, and understanding the variables that you need to look at in order to improve these 3 particular metrics inside of your business. This is Josh Belk with the Belk on Business podcast. Hope this particular podcast brought you value. If you haven't already, please consider subscribing. I'd love to hear any comments that you have. Have a wonderful day.